through this topic. So there are two chapters that we need to cover for this topic. And the first chapter is looking a little bit at capital market history and considering two really important concepts in finance called risk and return. There are some calculations in this topic. So there are some new formulas that we'll have a look at today. Any new formulas will get added to the formula sheet as well. That'll be there for your final exam. So we'll talk about how we calculate what's called return on investment. Whether you're a financial manager or whether you're just an investor, you would be very interested to know what sort of return you're earning on your investment. And we'll talk about how we can measure the return in dollars and as a percentage, as a rate of return. We'll have a pretty brief look at historical returns. And the point of looking at historical returns is just to try to consider together the concept of return with risk of an investment. Because risk and return go hand in hand when we're investing. And we'll talk about something called market efficiency as well as part of the first chapter in this topic. So we'll start off with calculating returns. So there's two ways that we can measure return. We can calculate the return in dollars. The total dollar return from an investment is calculated as the dollar dividends plus the dollars of capital gain to work out the total dollar return. The total dollar return means that we add together the income or the dividends and the capital gain. What does capital gain mean? What's a capital gain? Yes. If you buy an asset and the asset increases in price, then you make a capital gain. If you buy an asset and the price of the asset falls, you make a capital loss. So a capital gain is when the price of the asset, or in this case, the shares, increases after you purchase it. So you might pay $5 to buy a share in a company and the share price increases to $7. So you would make a $2 capital gain. So the dollar return is made up of the income component. If it's shares, your income from shares is the dividends that you get and the capital gains, which is the increase in price of the asset. But in finance, more often we measure returns as a rate of return rather than dollar returns. If I'm looking at investments or I'm trying to decide what would make a good investment, I'm normally interested in the rate of return from the investments that I'm considering. So to measure the return as a percentage, as a rate of return, we need to add together the dividend as a percentage, which is called the dividend yield. Instead of dividend in dollars, now we're going to work out the dividend yield, which is expressed as a percentage, plus the capital gain yield. So that's the more common way of measuring and expressing returns in finance. We normally look at percentage returns rather than dollar returns. So the dividend yield, which is what this DY means here, dividend yield. The dividend yield is calculated as the dividend at time t plus 1 divided by the price at time t. So if t is 0, then that's saying the dividend yield is D1 over P0. The dividend over the price is the dividend yield. Dividend divided by price is how we're expressing that dividend yield. And then the capital gains yield. The capital gains yield is calculated as the price at time t plus 1 minus the price at time t all over the price at time t. So we could say that's like saying P1 minus P0 all over P0. The price at time 1 minus the price at time 0 divided by the price at time 0. So this is your capital gain in dollars divided by the price, and express it as a percentage. So the total percentage return from a share is made up of the return from the dividends expressed as a percentage. So that's the dividend divided by the price, plus the capital gain expressed as a percentage, which is the capital gain divided by the price. So dividend yield is just the dividend divided by the price. The capital gains yield is just the capital gain divided by the price. We express them as a percentage. We add the percentages together and we get the total rate of return from the share. So there's an example on the next slide that we can have a look at that will get us to calculate the return in dollars and the return as a percentage, the rate of return. So in this example, we have a share that you buy for $25. So you buy the share, that's your initial price, that's your P0. $25 is your P0 or initial price. After 1 year, the share price is $35. So that's our P1, the price after 1 year, $35. The share paid a $2 dividend. So we've got our dividend. What was your total return? Total return can be measured in dollars and as a percentage. So we'll do both. The total return, if we measure it in dollars, is made up of the dividend in dollars. The dividend was $2 plus the capital gain in dollars. We made a $10 gain we bought the share for $25. The share price went up to $35. So we made a $10 gain, plus we got a $2 dividend. Our total dollar return on that share is $12. But we like to express it as a percentage or a rate of return. So the dividend, if we expressed it, so this is actually the dividend yield. Dividend yield is the $2 dividend divided by P0, the price that we paid initially. So the dividend yield is 8%, and the capital gain yield is the capital gain divided by P0, or 40%. So a dividend yield of 8%, a capital gain yield of 40%. Our total return as a percentage is 48%. It's our dividend yield plus our capital gain yield, 48%. So when we measure returns, we can measure returns as an amount of dollars or as a percentage. The percentage is the more common approach in finance. And as we work through this chapter and the next chapter, and we look at measuring returns for a single asset or a portfolio of assets, we'll be measuring returns in percentages. So that's the more common way. So we're just going to have a really quick look at some of these next slides. And we're going to have a look at slide 8. Slide 8 has some graphs. And the graph at the top shows us the returns on different asset classes. And I can see that the blue line is equities or shares. The green line is the returns on bonds. And the red line is the returns on bills. Why are the returns on shares, why are they so much higher than bonds? It comes down really to risk. It's this relationship between risk and return in finance. They go hand in hand. If you want to get a higher return from an asset, you have to take more risk to get a higher return. And investors, if they do take more risk, they expect to be compensated with a higher return. Equities are much higher risk than bonds. Bonds are a much safer investment, and bills are even safer again because they're more short term. So you're taking less risk. So the lowest risk asset class that we're looking at here are the bills, and they have the lowest returns. Bonds are a little bit riskier. The returns are slightly higher. And then shares or equities are much riskier, and on average, they have much higher returns. So it just comes down to the relationship between risk and return. So risk is defined as the probability that the actual return that you get will be different from what you expected. That's what risk is. The actual return that you get from investing will be different from what you expected. The higher the probability that the actual return will be different from what you're expecting, the higher the risk of the asset. And return is the financial compensation that you get from investing in the asset. And they always go hand in hand. You cannot make an investment decision without considering both risk and return. A rational investor will always consider those two together. They'll consider the probability that their actual return is going to be different from what they're expecting, and they will consider how much financial compensation they can get from investing. So this graph is looking at historical returns from assets. And the only reason it's here is just to show you that the riskier assets, the equities, on average, have higher returns than bonds and bills because they're safer, less risk. If we just skip ahead to some of the terminology that we're going to use in this topic. Yes. Yeah. Well, there's no guarantees with any of the investments, but because the bills are short term, if you expected that the value of the bill might be, if you could see that market conditions were changing and the value of the bill might fall, typically an investor would sell it so they could cash out of that loan. So because they're short term, they're quite easy to sell. There's a really liquid market for bills. So I would argue, given their short-term nature, that you're actually taking less risk because you're only making a short-term loan. I can see what you're saying about the line dipping below 1 along here in the 1950s, 60s, 70s. But as an investor, if that's not going to give you an adequate return, you wouldn't invest in that asset.
So is it timeline? So is it $1 invested at 90 that you're looking at, or is it?
It started at 1900. Let me just.
Are we comparing $1 invested in 90 or invested in that year?
I'm not actually sure how they plotted that graph, like what data they used to plot the graph. But what they plotted it for was to work out from the 1900s what the average return over 100 years, what the average return from those asset classes is. But I'm not sure how they worked out all the dot points on the graph. They just did that to get these average returns over a really long period of time. It would be in the textbook. Those graphs are from the textbook if you wanted to have a look just to see how they got their data. And that kind of leads into the next point. So these are showing you the average historical returns for these asset classes. So in Australia, the average historical return for equities is 6.7% per year, but that goes right back to 1900. If you looked at a shorter period of time, if you looked at, say, the last 30 years, you would end up getting a higher average return per year. And bonds, the average return per year is 1.7%, but it goes back so far. They're not really relevant to us now for investment decisions. The only purpose of the graph is to show you that equities on average have higher returns than bonds and bills because they're riskier. It's a riskier asset. So these graphs are illustrating average historical returns from the asset classes. And that's the first definition on the next slide that I wanted to have a look at with you. The average historical return. And we'll be doing this, we'll be doing some calculations of average returns. To calculate an average return, all we do is we add up all of the returns and divide by the number of observations. So if I have returns from 5 years, I add all of the returns together from each year and divide by 5 because I've got 5 observations. Another term that we're going to look at in this topic is called the risk-free rate. The risk-free rate is the rate of return that you get from investing in a risk-free asset. The return that you get from investing in a risk-free asset. And I know it sounds really strange to say that any asset would be risk-free, but in Australia, the closest thing we have to a risk-free asset is a Commonwealth government bond. The Commonwealth government in Australia is considered completely unlikely to ever default if they borrow money from you. If they borrow money, they will pay it back. So we consider these Commonwealth government bonds to be a risk-free investment. The government is not going to default. The government will pay the loan back. And usually the ones that we use as our risk-free asset, we should add in that they're Commonwealth government, because in Australia we have 3 levels of government. So the Commonwealth government bonds are considered to be the Treasury bonds, and we use the yield on a 10-year Treasury bond. The yield on a 10-year Treasury bond is considered to be the rate of return on a risk-free asset. So we'll be referring to the risk-free rate of return, and that's what we would use. We would look up and see what are the yields on 10-year Commonwealth government bonds, and that would tell us what to use as a risk-free rate. And the last term, risk premium. Risk premium means the extra return that you get from an asset above the risk-free rate. The extra return that you get from investing in a risky asset above the risk-free rate of return. So if the risk-free rate of return, let's just throw some numbers in. Let's just assume the risk-free rate of return is 5%. If you can earn 12% from a risky asset, 12%, and the risk-free rate's 5%, how much is the risk premium? 7%. It's the extra return you get above the risk-free rate of 5%. So if you invest in this asset and you get a return of 12%, you're getting an extra 7% return because it's a risky asset. So we call that the risk premium, the extra return you get from investing in a risky asset above the risk-free rate. So it sounds like a lot of terminology, but these will come up as we start working through the topic. Before we start doing calculations around risk premium, we actually need to have a look at measuring risk and return. And we actually use a statistical method to measure risk in finance. To measure risk, we calculate something called standard deviation. Has anyone heard of standard deviation? Standard deviation is a statistical term. It's a way of measuring how much something varies around an average return. Standard deviation. So we're going to look at measuring risk for a risky asset. We're actually going to look at calculating the standard deviation for a risky asset. And we're going to look at calculating the average return as a part of that process. So in order to measure the standard deviation, so risk is measured by calculating the standard deviation of returns for a risky asset. And standard deviation measures how much the actual returns vary from the average return. Let's shorten it. Standard deviation. So we're actually going to look at calculating this standard deviation because that's how we measure risk. To calculate the standard deviation, we need to calculate the variance first, and then the standard deviation is the square root of the variance. There's a formula right down here at the bottom. This formula is to calculate variance. So the variance is the sum of the actual return. So RI is the actual return minus the average return squared. So we would have a set of actual returns. We might have the actual returns for a risky asset over 5 years. So we have 5 actual returns. So we take each return, we subtract the average return, and we square it. And we sum all of those together. And we divide by t minus 1. T is the number of observations that you have. So if we have 5 years of returns, T would be 5. We have 5 years of data. T is 5. So we divide by T minus 1. And I'm going to show you how to do it because looking at that formula doesn't really make a lot of sense. It makes more sense to look at the calculation itself. So what we're going to do is we're going to measure the risk of a risky asset. To measure the risk of the asset, we need to calculate the variance. And from the variance, we can then calculate the standard deviation. The standard deviation, as it says here, is just the square root of the variance. So the standard deviation, sigma, is the square root of the variance. So our first big step is actually trying to calculate variance. Once we get the variance, then all we have to do is put it in the calculator and take the square root of it. So we have some data and we just need to focus on the data that we start with. In this case, we've got a risky asset and we have 4 years of actual returns for that risky asset. So this column here, column 2, this is the data that we started with. For the asset in year 1, the asset had a return of 10%. That was the actual return from the asset in year 1. Remember, this is historical data. This is past information. So the first year of data, the actual return was 10%. In the second year, the actual return from the asset was 12%. In the third year, the actual return was 3%. And in the fourth year, the actual return was minus 9%. So the 4 pieces of data here in column 2, that's all that we had to start with. We've got an asset and we've got 4 years of actual returns for the asset. Step one is calculate the average return. Calculate the average return. I've got the actual returns here in column 2. Step 1, calculate the average return. The average return means add them all together and divide by the number of observations. If we add all of these actual returns together, the sum of those actual returns is 16% or 0.16. Add them all together and divide by the number of observations. There are 4 pieces of data. So 0.16 divided by 4 gives us an average return of 4%. So that should always be our first step. We have the historical returns. Step 1, calculate the average return. So add them all together and divide by the number of observations. So add the returns. We got 0.16. There are 4 pieces of data. So divide that by 4 and you get an average return of 4%. Step 2 is now to use this average return. And what we want to do is we want to calculate the difference between the actual return and the average return each year. So we just added another column, and in this column, we've put the average return. We calculated the average returns 4%. We've put 4% all the way through this column. That's the average. So now we're going to do the calculations for column 4. Column 4 is the difference between the actual return and the average return. So in year 1, the actual return was 10%. The average return is 4%, so the difference is 6%. In year 2, the actual return is 12%. The average return is 4%, so the difference is 8% in year 2. In year 3, the actual return was 3% and the average return was 4%. So the difference is minus 1% in year 3. And then in year 4, the actual return was minus 9% and the average returns 4%. So the difference is minus 13%. So step one was calculating the average return. Step two is calculating the differences between the actual and the average. Step 3, square the differences. So we take the difference from year 1, 0.06 to the power of 2. 0.06 to the power of 2 gives us 0.0036. So we're squaring it. Squaring it means to the power of 2. In year 2, the difference was 0.08. So put that in the calculator to the power of 2, and you get 0.0064. In year 3, our difference was minus 0.01. Put that in the calculator to the power of 2, and you get 0.0001. And the last one, minus 0.13 to the power of 2 is 0.0169. So step 1, calculate your average return. Step 2, calculate the differences between the actual and the average return. Step 3, square all the differences and add them all together and get the total. And this sum that we get here, 0.027, this sum is the top part of the formula. It's this. It's the sum of the differences squared. So 0.027 is the sum of all the squared differences. To get the variance, we have to divide it by t minus 1. So the sum of all the squared differences is 0.027. To get this variance here, you need to take the sum and divide it by t minus 1. What will t be? 4. So you take your sum and you divide it by 3. T is 4. 4 minus 1. So the sum divided by 3 gives us the variance. We finally get the variance after all of those calculations. But we can't stop at variance, because when we talk about risk, we don't talk about risk in terms of variance. We actually talk about it in terms of the standard deviation. So to go from this variance to the standard deviation, put 0.009 into the calculator and square root that number. So we use the square root button on the calculator, take the square root of 0.009, and you will get this standard deviation. So the standard deviation is normally expressed as a percentage. So the percentage in this case, we would express it and say it's 9.49% or 9.5%. The higher the standard deviation, the higher the risk for the asset. So a higher standard deviation means higher risk. So if we have a risky asset, we can calculate the variance and the standard deviation, which is how we measure risk in finance. And this standard deviation is a measure of total risk. And later on, if we get there, later on in the topic, there's some discussion about the components of total risk. But this standard deviation is a measure of the total risk of an asset. The higher the standard deviation, the higher the risk of the asset. So we always follow the same steps. Step 1, calculate the average return. Step 2, calculate the differences. Step 3, square them, sum them. And then step 4 is calculating that variance. And the variance was the sum divided by t minus 1. T is 4 because we've got 4 pieces of data or 4 observations. Yep.
How much it should be higher though? Like it's 0.09. How do you define if it's higher though?
Normally that's a relative term, so you would need something to compare it to, whether you're comparing this asset to another asset, or you might be comparing this asset to a risk-free asset to decide. So you need something to compare it to make a decision. Yes, normally. So I think there's an example that we'll have a look at where there's 2 assets and we'll calculate both the standard deviations, and one of them will actually be a lot higher than the other one. Yeah. Are there any questions that you guys have about calculating variance or standard deviation? If you get stuck, that example I think is a really good one because it's really clear how it sets out the calculation. So if you're doing the calculations for other questions or other examples and you get stuck, come back to this one. It's good to set it out in a table like that and use the same columns because it's really clear and easy to follow. So in this example, we used an average. And the average that we calculate here is the arithmetic average. The arithmetic average. I prefer to think of it as the normal average, the normal way of finding an average. Add up all the pieces of data and divide by the number of observations. It's our arithmetic average. So that's what we've just looked at. We've just looked at calculating the arithmetic average. The average return we did was an arithmetic average. Add up all the returns and divide by the number of observations. But in finance, we have another average return, and the other average return is called the geometric average. And I'm not going to go into details about this geometric average because the average that we use more commonly is the arithmetic average. You need to know how to do that one. The geometric average is used when you're analyzing data over a really long period of time. And I mean really long. I'll show you. There's another slide here. I'll show you. If you're analyzing data over a period of more than 40 years, then it would be appropriate to use the geometric average. Otherwise, if you're analyzing data over a period of 1 to 40 years, then it would be appropriate to use the arithmetic average. So for our purposes, if you were doing a question in the final exam, I'm not going to give you more than 40 years of data in an exam question. If you were calculating an average return in the exam, I would just give you a small data set. So that would just be the arithmetic average. I left it in there because it is good to know there's two different ways of determining average, but we're just going to focus on the arithmetic average because that's for really long-term situations. Another concept that we need to consider in this topic is the concept of efficient markets or market efficiency. Market efficiency is looking at whether assets are fairly priced by the market. How quickly is new information reflected in the asset price is how we tend to think about efficiency. How quickly is new information reflected in an asset price in the market? So efficient markets are markets where assets are generally fairly priced. So that means most of the time, it's difficult to find a bargain. It's difficult to find something that is cheaper than what it's actually worth because most of the time the assets are fairly priced by the market. That means as new information is revealed by the company, as the company discloses information to the markets, that new information is very quickly analyzed and reflected in the company's share price. But there are different forms of efficiency. There are different forms of efficiency that we're going to consider, but efficiency is really considering, are the assets fairly priced? How quickly is new information reflected in asset prices by the market? And we're actually very lucky that we have lots of investors that are doing research all the time, gathering information about companies, analyzing the information, and incorporating their analysis into what they think the company's shares are worth. We have lots of super funds, managed funds. Managed funds pay people to gather information and analyze information. That was my job at Macquarie Bank. That's what I got paid to do every day for an investment bank. We used to gather information, analyze the information, and decide whether or not we thought the asset was fairly priced. And if not, we would trade or recommend our clients to trade on that information, and it would adjust the price of the asset. Because there are so many large investment banks and super funds and small investors that are always gathering and analyzing information, and they're incorporating that information into what they think the assets are worth or the company's shares are worth. Most of the time, the company's shares on the ASX are pretty fairly priced. And most of the time, they reflect all of the available information. So there's lots of investors doing research. They analyze the information, and prices typically reflect all of the publicly available information. So that's what helps our markets to be efficient. Because we have these investors that are spending so much time gathering and analyzing information. In terms of efficiency, there are three forms of market efficiency, which are summarized on this PowerPoint here. So the first one is called strong form efficient markets. The second one is called semi-strong form efficient markets. And the third type of efficiency is weak form. So we'll have a look at each of those and see what capital markets in Australia, what form or type would they generally fit into. And if a market is strong form or semi-strong form, what sort of information is reflected in the asset prices in the market. With a strong form efficient market, with strong form efficiency, asset prices reflect all information, public and private information. But I really don't understand how a market could be strong form efficient, because if prices reflect private information, then I would argue the information's not private anymore if it's been incorporated into the asset price. Our capital markets are not considered to be strong form. I don't know that any market would be considered strong form, because I don't actually know how asset prices could include public and private information. The form of efficiency that's most applicable to our capital markets is the semi-strong form efficiency. So with semi-strong form efficiency, and I think this one makes sense, the prices of assets, or if it's shares, the prices of shares, they reflect all publicly available information. So all information about the company that has been announced to the public, all that information. So anything that they've included in their annual report, anything that they have included in a press release, all of that information has been analysed by investors and it's reflected in their current asset prices. So our capital market in Australia, we would argue that it's more like semi-strong form efficient. We have a lot of investors that analyse all this publicly available information. Our assets are normally fairly priced, but the prices only reflect the publicly available information. So the third type of efficiency is the weak form efficiency. With weak form efficiency, the prices just reflect historical market information. So they just reflect historical prices and trading volumes. So they don't actually reflect much information, just historical trading information like past prices and past trading volumes. So efficient markets is looking at whether assets are fairly priced by the market. And we would argue that a market is efficient if the market can quickly incorporate new information into asset prices. Then we would say it's efficient. So from that first part of the topic, we looked at measuring returns for assets. We looked at calculating the return in dollars and the return as a percentage. So we normally would focus on the percentage returns. And we also looked at measuring risk, because risk and return go hand in hand. For an investor to invest in a riskier asset, the investor would expect a higher return. We can measure the risk of an asset. If we've got some historical returns from the asset, we can calculate the standard deviation to measure the risk of the asset. The higher the standard deviation, the higher the risk. And we know the higher the risk, the higher the return investors would expect to earn. So in that chapter, we were really focusing on historical data, using historical returns or past returns to do calculations. In the next chapter, we actually look forward to the future, and we talk about what's called an expected return. So in the previous chapter, we were looking at historical or past returns. When we talk about expected returns, we're looking forward, not looking back at the past. So we're going to talk about how we can calculate these expected returns looking forward. And we're going to talk about the concept of diversification. Does anyone know what the word portfolio means? If I said you have a portfolio of assets, what does that mean? Yeah, a number of different assets. That's all it is. So a portfolio is just a number of assets that you've invested in instead of just one asset. What does diversification mean? Yeah, investing in different assets. We have a saying, we say, don't put all your eggs into one basket. We say you should diversify, don't put all your eggs into one basket. And the funny thing is, I live on a farm and I have chickens. I've got 20 chickens, and I go and collect the eggs from my chickens, and I take one basket and I put all the eggs into my one basket. And almost every day I laugh thinking I always tell people, don't put all your eggs into one basket. That's what I do with my chickens every day. But diversifying means that. Don't put all your eggs into one basket. What happens if I drop the basket? I lose all the eggs. By diversifying, you're investing in different types of asset. So if one asset performs badly, you might be losing money on one asset, but the other assets might be performing well. So let's have a look at this concept of expected return. Expected. Expected means we're looking forward. We're not looking at the past. We're now looking forward. We need to have estimates for the future. We're looking forward. An expected return can be calculating using, we can calculate it using probabilities. The expected return for an asset is equal to the sum of the probability of a state occurring multiplied by the expected return in that state. Now, that doesn't sound like it makes much sense, but when we have a look at an example, it will make more sense. The point is to work out the expected return. We're looking forward. This is not actual past data. We're now estimating what might happen in the future. And we estimate probabilities and returns in the future. So let's look at the example to try and make sense of that formula. So in this case, the states refer to the state of the economy. So we're thinking that moving forward, there are two possible states for the economy. The economy could either be in recession or boom. They're the two possible situations in the future. And the reality is, yes, there could be more than just two possible states, but we've used two to try and keep it simple. Two possible states and the probability of each one happening. So there's a 50% probability the economy will be in recession and a 50% probability the economy will be in boom. So two states, and we need to know what probability or how likely is it each of those states will happen. And we have two assets that we're going to look at. The first asset is shares in a company called EMU. The second asset is shares in a company called Kiwi. For the shares in the company called EMU, we have to estimate the expected return in the two possible states for the economy. So for shares in EMU, if the economy is in recession, the expected return from those shares is minus 20%. If the economy is in boom, the expected return from EMU shares is 70%. So these are estimates. We're forecasting because we don't know what's going to happen in the future. So we have to forecast the probabilities. We have to forecast the expected returns. And then for shares in Kiwi, the expected return if the economy is in recession is 30%, and the expected return in boom is 10% for shares in Kiwi. So these are also forecasts for the future. These are two good assets to put together in a portfolio because the returns are quite different. When the economy is in recession, EMU has a negative return, but Kiwi actually has a high positive return in recession. So they're two good assets to combine together in a portfolio. So what we want to do is calculate the expected return. So just going back, the expected return is the probability of the state occurring multiplied by the expected return in that state. So if we start with the expected return from Kiwi, K for Kiwi, the expected return from Kiwi, there's a 50% probability that the economy will be in recession. And in recession, the return from Kiwi is 30%. Let's just go back and check that. So it's Kiwi. So there's a 50% probability of recession. In recession, the return would be 30%. So 50% multiplied by 30% is the first part of the calculation. So that's for recession. And then we need to consider the other state, which is boom. And there's a 50% probability of the economy being in boom, plus we know that the return in boom is 10%. So 50% multiplied by the expected return in boom, and we add those two together. So the first one is if the economy is in recession, and the second one is when the economy is in boom. Multiply the expected return by the probability and add them together. So the overall expected return from shares in Kiwi is 20%. We repeat the calculations for the other asset, which was EMU. There's a 50% probability that the economy will be in recession. And in recession, EMU has a return of minus 20%. And there's a 50% probability that the economy will be in boom. And in boom, EMU has a return of 70% expected. So we multiply those, add them together. The expected return from EMU is 25%. Given what you know about the relationship between risk and return, looking at these expected returns, so we've got Kiwi at the top, Emu underneath, which asset is the riskier asset? Emu. The expected return is higher from Emu, so I would also expect the standard deviation to be higher. If we calculate that, I would expect it to be higher. Something else that we're going to calculate is that concept of risk premium. Remember, we talked about risk premium, the extra return that you get above the risk-free rate. If the risk-free rate is 8%, how much is the risk premium for Kiwi? Kiwi's got an expected return of 20%. So how much extra return do we get above the risk-free rate? We get an extra 12% as our risk premium. The extra return above the risk-free rate. Are there any questions about calculating those expected returns? So this is different from what we were doing before. In the previous chapter, we were using historical data, actual historical data. Now we're estimating what might happen in the future. And if we're looking into the future, we also need to consider the probability of that state or that situation happening in the future. We can also calculate variance and standard deviation using our expected returns. So we're forward-looking. We can calculate the variance and standard deviation forward-looking using expected returns. When we did this before, we used the actual historical data, but we can also do it looking forward. So remember, we're forecasting the probabilities and the expected returns. So it's not necessarily what the risk is going to be in the future, but it's our forecast or estimate of what we think it will be. So if we wanted to calculate the variance, now to calculate the variance looking forward using expected returns in the future, the variance is equal to the sum of the probability of a state occurring, the probability is P, multiplied by the expected return, the return in that state, minus the total expected return from the asset. And we square. So we're calculating the difference, squaring the difference, and multiplying it by the probability and summing them all together. It's similar to what we did before. Before we just had the return minus the average return squared. We summed all of those together. We didn't have probabilities before. And we divided by t-1 before, but now we're not using actual data. We're not using historical data. We're looking forward. We're using expected future data. So the variance is the sum of the probability multiplied by the difference squared. So if we have a look at those same two assets, we've got shares in Emu and shares in Kiwi, and we already calculated the expected returns. So let's just copy those. The expected return for Kiwi was 20%. So we've already calculated the expected returns for these two assets, Kiwi and Emu. And now we're going to use that formula that we just had a look at. That formula incorporates the probability. And now we need to find the difference between the return and the expected return, square it, and multiply it by the probability. So the first one that we're calculating is Kiwi. So I did Kiwi as blue. So let's make this blue for Kiwi. So we're going to calculate the variance for Kiwi. So the variance is the sum of the probability multiplied by the difference squared. So there's a 50% probability that the economy will be in recession, 50% probability of recession. And in recession, the expected return from Kiwi in recession is 30%. Let's go back and confirm. In recession, the expected return from Kiwi is 30% in recession. The total expected return from Kiwi is 20%. But in this state of recession, the expected return in that state is 30%, and there's a 50% probability of that state occurring. So probability multiplied by the expected return in that state minus the total expected return for Kiwi. 30% expected return in recession. The total expected return for Kiwi was 20%. So there's a 10% difference, square it, and multiply it by the probability of 50%. Plus, there's a 50% probability that the economy will be booming. When the economy is booming, the expected return from Kiwi is 10%. So the expected return in boom minus the total expected return from Kiwi of 20%. So you can see these two are the same. We're subtracting that total expected return that we calculated previously. So when we calculate the variance is 1%, 0.01. The standard deviation is the square root of the variance. The square root of 0.01 is 0.1 or 10%. So the standard deviation for the asset shares in Kiwi is 10%. We also need to calculate the standard deviation for shares in Emu. So we do the same thing. There's a 50% probability that the economy will be in recession. In recession, the expected return from Emu is minus 20%, and we subtract the total expected return that we calculated previously. So minus 20%, minus 25%, and square it and multiply that by 50%. Plus, there's a 50% probability the economy will be in boom. And if the economy is in boom, the expected return from Emu is 70% if the economy is booming. So 70% minus 25% and square it. Calculate the difference and square it and multiply it by the probability of 50%. So we get a variance of 0.2025. And if we take the square root of that variance, we get the standard deviation. So first we calculate variance, then we take the square root and get the standard deviation. So we talked about this before when we calculated the expected returns. The expected return from emu was higher than kiwi. And I said, why? And it comes back to risk. The standard deviation for emu is 45% compared to 10% for kiwi. It's much higher. So it means it's higher risk, and therefore we expect a higher return from that asset. So in the previous chapter that we looked at first, we looked at using historical returns, actual historical returns, to measure risk to calculate the standard deviation. But what we've just looked at now is to use expected returns in the future to measure risk, calculating the standard deviation. Now, this example, I think, is a bit more complicated because there's two assets. If this example is confusing you, just completely ignore one of the assets. So if you find this really confusing, then my advice would be focus on just one. Pick emu or kiwi and just focus on one. And calculate the expected return for just one, and calculate the variance and standard deviation for that same one, and ignore the other one if it's confusing you. Because you'll find if you strip out one of the shares and just focus on one, it makes sense and it looks similar to what we did previously, except that we're using expected future returns. So if you need to work through that one again, just completely ignore either emu or kiwi and just focus on the calculations for one. We've talked about this concept of a portfolio. A portfolio means a number of assets. So you're investing in more than one asset, a collection or group of assets. And we can calculate the expected return and the risk. We can calculate it for a single asset, and we can calculate it for a portfolio of assets. In this previous example, if it makes more sense, just focus on one. For example, you might choose shares in kiwi and focus on the calculations for kiwi. So we calculated the expected return for kiwi. The expected return was 20%. Then we calculated the variance for kiwi, and then we took the square root of the variance to get the standard deviation. So we calculated the expected return and the risk for a single asset for kiwi. But we can apply very similar calculations to a portfolio, to a collection of assets. The calculation down here is slightly different to what we did before. Now we're saying this is the expected return from our portfolio, from our collection of assets. And the expected return from the portfolio is equal to the sum of the weight. W stands for weight. So now we're not using probability. Now we're actually using the weight, which means the proportion of your money that's invested in a particular asset, a single asset. because your portfolio is made up of a number of assets. So the weight means the proportion of your portfolio that is invested in a particular asset multiplied by the expected return from that asset. So if you've got 3 assets in your portfolio, you would need to take the weight, how much you've got invested in each one, and multiply it by the expected return for each one. So 3 assets, you would have 3 weights and 3 expected returns. Multiply them and then add them all together. So if we have a look at an example here, let's say we wanted to calculate the expected return from our portfolio. We've got these same 2 assets. We've got the EMU shares and the Kiwi shares. And to calculate the expected return of our portfolio, 50% of our money is invested in Kiwi and 50% of our money is invested in EMU. They're the weights. But we need the expected returns. We've already calculated them. So I'm going to copy these. We've already done those calculations. We don't need to do those again. So we've got the weight, we've got 50% of our money invested in Kiwi, and we know the expected return from Kiwi. We've got 50% of our money invested in EMU, and we know the expected return from EMU. So to work out the expected return from our portfolio, all we have to do is multiply the weight by the expected return and add them together. So I'm going to do that here. So the expected return from our portfolio is made up of shares in Kiwi and shares in EMU, is equal to 50% of our money is invested in Kiwi, and the expected return from Kiwi is 20%, plus 50% of our money is invested in EMU, and the expected return from EMU is 25%. So the formula sort of looks confusing, but it's really just that simple. The weight is 50%. So 50% multiplied by that expected return that we already calculated. The weight of the other asset in the portfolio multiplied by the expected return from that asset, and just add them together to get the total. If I had 4 assets in my portfolio, then I would have 4 calculations all added together. So we've looked at measuring return. We've talked about how return can be measured as a total dollar return, or we can measure the total percentage return from an asset. We've looked at measuring the risk for an asset using historical returns, the historical actual returns from the asset. In chapter 11, we then started to look at expected returns in the future. We looked at calculating the expected return from an asset in the future and measuring the variance and standard deviation using the expected returns in the future. What you really need to do with this topic that we've gone through so far is you really need to focus on the calculations for a single asset. practice calculating the historical average return and the standard deviation based on historical average returns. And then from this chapter, from chapter 11, then practice calculating the expected return from a single asset in the future and the standard deviation using expected returns for a single asset. And then just think about this concept of a portfolio. A portfolio means a collection of assets, and how we could measure the expected return from our collection of assets. I don't actually want to go past there. I don't want to look at calculating the variance and standard deviation for the portfolio, because I really want you to practice doing that for a single asset. So what I think we should do, I think we should pause here. We're at slide 38. I don't want to go into all those calculations. I want you to practice and try to understand all the calculations that we've covered up to that point. And if you can do that before next week we can hit the ground running, looking at portfolios, and we can go into calculating the variance and standard deviation for a portfolio. But you won't be able to do that effectively until you're good with doing it for a single asset. So we'll pause there. We'll pick up from slide 38, 39 next week. We'll continue on from this point. If you've got any questions on any of those calculations, come and see me. And next week, we'll go through and have a look at the assignment and talk about the assignment questions as well.